Let me ask you a question that most retirees have never been asked directly. Do you actually know what is in your retirement portfolio right now? Not just the account balance, not just the name of the fund your advisor put you in 15 years ago, but specifically, what percentage is in stocks, what percentage is in bonds, what percentage is in cash, and most importantly, is that mix actually designed for where you are in life right now? Because here is what I see over and over again when retirees look at their portfolios honestly for the first time in years. Either they are far too aggressive, still holding the same growth-heavy stock portfolio they had at 45, taking on enormous risk they do not need and cannot afford, or they are far too conservative, sitting in bonds and cash that are quietly losing purchasing power to inflation while their money fails to keep up with the actual cost of retirement. Both of those portfolios are wrong, and both of them, in different ways, put your retirement at risk. The too aggressive portfolio can be devastated by a market crash at exactly the wrong time. The too conservative portfolio is devastated slowly and silently by inflation over 20 years. The right retirement portfolio is neither of those things. And today, we are going to build it from scratch, in plain language with real numbers, and with a clear framework you can apply to your own situation starting this week. Hey everyone, welcome back to Life Advice. I'm your name. Today we are talking about one of the most important and most misunderstood topics in all of retirement, how to actually invest your money once you stop working. Because the rules change completely in retirement, and most people are still playing by the old ones. Let's fix that right now. Let's start with the most important concept in retirement investing, and it is one that most people intellectually understand but emotionally resist. The goal of your portfolio changes completely when you retire. During your working years, your portfolio had one job: grow. You were in accumulation mode. You were adding money every month. You had decades of time. Market downturns were actually opportunities. They let you buy more shares at lower prices. Volatility was your friend because you were not spending the money, you were adding to it. The longer the time horizon, the more risk you could absorb. A 40% drop in the market meant your future contributions bought in cheaper. It hurt to watch, but it did not hurt your actual retirement. But when you retire, everything changes. Now your portfolio has a different job. It has to do two things simultaneously that are in tension with each other. It has to generate reliable income to fund your living expenses right now. And it has to grow enough over time to keep pace with inflation and last 25 to 30 years. Income today, growth for tomorrow, at the same time, from the same pool of money. And here is the critical difference that changes everything about how you invest. In retirement, you are no longer adding money, you're taking it out, which means market downturns are no longer buying opportunities. They are losses. Real permanent losses if you are forced to sell depressed assets to fund your monthly expenses. The sequence of returns, risk we have talked about on this channel before, becomes the dominant risk in your financial life. The shift from accumulation to distribution, from adding to subtracting, requires a fundamentally different portfolio structure. Not just a more conservative version of your accumulation portfolio, a structurally different one. One that is specifically designed to deliver income reliably, protect against sequence risk, maintain enough growth to fight inflation, and give you the psychological stability to stay invested through market turbulence without panic selling at the worst possible moment. That is the retirement portfolio, and most people do not have it. Before we build the right portfolio, let's look clearly at the two most common wrong ones, because understanding why they fail is the fastest path to understanding what works. This is the retiree who never updated their investment strategy. They built an aggressive growth portfolio during their 40s and 50s, maybe 80 or 90% in stocks, and never meaningfully changed it when they retired. Why would they? It had worked for decades. It had built the wealth that funded their retirement. And the financial media kept telling them that stocks are the best long-term investment, which is true. But that truth has a crucial qualifier: over the long term. The problem in retirement is that you do not always have the long term. If the market drops 40% in your first 2 years of retirement, as it did in 2000 to 2002, and again in 2008 to 2009, and you are simultaneously withdrawing money to live, you are selling shares at their lowest value. Those shares are gone. When the market recovers, your portfolio recovers from a permanently smaller base. And research from Vanguard and Morningstar consistently shows that this early retirement sequence of bad returns can permanently impair a portfolio's ability to sustain withdrawals, even if the long-term average return ends up being perfectly acceptable. A retiree with a 90% stock portfolio who retired in early 2000 and withdrew 4% annually saw their portfolio drop so severely in the first 3 years that many ran out of money by their late 70s. Despite the market eventually recovering and delivering solid long-term returns. The timing destroyed them, not the long-term average. The sequence. Wrong portfolio number 2, the all-conservative safe portfolio. This is the opposite error. And it is just as dangerous, just slower and quieter. This is the retiree who, terrified of market loss, moved everything into bonds, CDs, money market accounts, and savings accounts. Zero stock exposure. Nothing that can drop. And for the first few years, this feels brilliant. No volatility, no scary headlines, no stomach-dropping account statements, just steady, predictable, boring income. But then year 5 arrives, and year 10, and the cost of living has gone up 3% per year. Their fixed income from bonds and CDs has not kept up. The purchasing power of their portfolio is eroding quietly, 3% per year, compounding. By year 15, the same portfolio that felt so safe is generating meaningfully less real income than it did at retirement. And by year 20, for a retiree who started at 65 and is now 85, the gap between what the portfolio produces and what life actually costs has become impossible to bridge. A portfolio that earns 2 to 3% in a 3 to 4% inflation environment is not a safe portfolio. It is a slowly failing one. The risk is just invisible compared to a stock market crash, but the outcome, running short of money in your 80s, is identical. The right retirement portfolio threads the needle between these two failures. It protects against sequence risk without sacrificing the growth needed to outpace inflation. And it does this through structure, not just through asset allocation percentages. Now let's build the right portfolio. And I want to be clear, there is no single perfect allocation that works for every retiree. Age, health, income sources, risk tolerance, and time horizon all matter. But there is a framework that research consistently supports, and that framework is built around 3 core components. This is your short-term income reserve: cash, money market funds, short-term treasury bills, and high-yield savings accounts. This layer holds between 1 and 2 years of your annual portfolio withdrawal amount. Its job is not to grow. Its job is to be there, stable, accessible, and completely insulated from market volatility, so that when the market drops, you are not forced to sell anything. This is the layer that breaks the sequence of returns trap. Because when stocks fall 30% in year 2 of your retirement, you are not touching your stock holdings. You are drawing from this stability layer. You wait, you let the market recover, and you only replenish this layer from your growth assets when the timing is right, not when the market forces you to. The psychological value of this layer is almost as important as the financial value. When you know your next 12 to 18 months of income is sitting in a stable account completely disconnected from market performance, you can watch market volatility with significantly less anxiety. You do not need to react. You do not need to sell. You can wait. And waiting is often the most valuable thing a retirement investor can do. This is your medium-term income engine: intermediate-term bonds, dividend-paying stocks, balanced funds, and real estate investment trusts. This layer generates steady, relatively reliable income, dividends, interest, distributions, and serves as the reservoir that replenishes your stability layer when it runs low. The income layer is not completely immune to market fluctuations. Particularly, the bond portion will respond to interest rate changes. But it is significantly less volatile than a pure equity portfolio, and its regular income distributions provide a cushion that reduces your need to sell principal to generate cash. For most retirees, this layer holds somewhere between 30 and 40% of the total portfolio. It is the bridge between the short-term stability of the cash layer and the long-term growth of the equity layer. Think of it as your medium-term fuel reserve, not as volatile as the growth engine, not as inert as the cash reserve, working continuously in the middle. This is the engine that determines whether your retirement lasts 20 years or 30 years. Broadly diversified equity investments, domestic stock index funds, international stock funds, small and mid-cap exposure. This layer is volatile. It will drop significantly in bad markets. It will recover and grow in good ones. And over a 20 to 25 year time horizon, it is the only component with the potential to meaningfully outpace inflation and grow your portfolio's real purchasing power. The key is that you are never drawing directly from this layer for living expenses. You draw from the stability layer. The stability layer is replenished by the income layer. The income layer is supplemented over time as the growth layer appreciates. The structure creates distance, financial and psychological, between your daily income needs and your long-term equity exposure. This distance is what allows you to hold 40 to 60% in equities without the emotional volatility that destroys most retirees' investment outcomes. Because when the market drops, your income for the next 12 to 18 months is already secured. The growth layer's decline is a temporary paper loss, not a cash flow crisis. Now, what does a specific allocation look like? For a 65 to 70-year-old retiree in good health with a 25 to 30-year time horizon, research from Vanguard, Fidelity, and Morningstar suggests an allocation somewhere around 50 to 60% equities and 40 to 50% fixed income in cash is appropriate. leaning more equity heavy for those with strong guaranteed income from Social Security and pension that covers most basic expenses, and more conservative for those who are heavily dependent on portfolio withdrawals for daily living. As you age into your 70s and 80s, the equity percentage typically declines modestly, not to zero, never to zero if you want inflation protection, but perhaps from 55% equities at 65 to 45% at 75 to 35 to 40% at 85. The income and stability layers absorb the difference as your time horizon shortens and your flexibility to wait out market downturns decreases. Now, let's look at the 3 specific mistakes that most retirees make with their portfolios, because knowing what not to do is just as important as knowing what to do. This is the single most destructive investor behavior in retirement, and it is entirely understandable. When you're watching your account balance drop $50,000, $100,000, $200,000, when financial media is screaming that the market is crashing, the emotional pressure to sell to get to safety, to stop the bleeding, is enormous. But selling during a downturn locks in your losses permanently. The shares you sell at the bottom are gone. You do not benefit when the market recovers. And research from Dalbar, which tracks the actual returns investors receive compared to the returns the market delivers, consistently shows that the average investor earns significantly less than the market because of poorly timed emotional decisions. The market might return 8% over a decade. The average investor in that market earns 5% because they sold during the drops and bought back in after the recovery, locking in losses and missing gains. The structural 3-layer portfolio we just built is specifically designed to prevent panic selling. When your daily income is coming from a stable cash layer that the market does not touch, you have no financial reason to sell your equities during a downturn. The psychological trigger for panic selling, I need to pay my bills and my portfolio is falling, is eliminated. In a low interest rate environment, or for retirees who are anxious about income, the temptation to reach for higher yielding investments is powerful. High yield corporate bonds, leveraged dividend funds, complex structured products promising 8 or 10% income. These look like solutions to the income problem, but they are often traps. High yield bonds, also called junk bonds, offer higher interest payments because the companies issuing them are at higher risk of default. In a market downturn or recession, exactly when you most need stable income, high yield bonds often fall sharply in value and may cut or eliminate their distributions. You reach for yield in calm markets and get hit hardest when markets are turbulent. Leveraged products amplify returns in both directions, meaning they amplify losses as readily as gains. For a retiree whose portfolio cannot absorb large losses, leverage is not an income solution. It is a retirement threat dressed up in an attractive yield number. The right approach is to accept modest yields from high-quality income sources, investment-grade bonds, dividend-paying blue-chip stocks, treasury securities, and let the growth layer of your portfolio provide appreciation over time. Total return, income plus growth, is a more reliable and more sustainable framework than chasing high current yield at the cost of principal risk. Rebalancing is the practice of periodically adjusting your portfolio back to your target allocation after market movements have shifted it away from those targets. It sounds simple. It is almost universally neglected. Here is why it matters so much. Say you start retirement with 50% in stocks and 50% in bonds. After 2 strong years for equities, your portfolio is now 65% stocks and 35% bonds. Without rebalancing, you're now taking on significantly more equity risk than you intended, precisely at a time when market valuations may be elevated and a correction more likely, and your stability and income layers may have been depleted without being replenished. Rebalancing, either on a calendar schedule such as annually or semi-annually, or when allocations drift more than 5 percentage points from targets, keeps your risk profile aligned with your intentions and your income structure intact. It also has the mechanical benefit of selling some of what has gone up and buying some of what has gone down, a disciplined form of the buy low, sell high principle that almost no investor can execute emotionally, but a rebalancing rule enforces automatically. Let's make this concrete. Here are the specific types of investment vehicles that belong in each layer of a well-structured retirement portfolio, and which ones to use carefully or avoid entirely. For the stability layer, high-yield savings accounts at FDIC-insured banks, money market mutual funds, short-term treasury bills with maturities of 3 to 12 months, and short-term CDs. These are boring. They are supposed to be boring. Their job is to be there when you need them, not to make you rich. For the income layer, intermediate-term treasury bonds and bond funds, investment-grade corporate bond funds, dividend-focused equity funds that hold established companies with consistent dividend histories, balanced funds that hold a mix of stocks and bonds in a single vehicle, and real estate investment trusts, REITs, which provide real estate income exposure without the management burden of direct property ownership. For the growth layer, Broadly diversified low-cost index funds are the gold standard. A total U.S. stock market index fund, an international stock index fund, and perhaps a small allocation to small and mid-cap funds for additional diversification. The research on active versus passive investing for retirement portfolios is unambiguous. Low-cost index funds outperform the majority of actively managed funds over time, especially after fees. In retirement, where every basis point of cost matters and time horizon is finite, minimizing investment costs is one of the most reliable ways to improve long-term outcomes. A word on annuities. Fixed annuities, which pay a guaranteed income stream for a defined period or for life, can play a role in the income layer for retirees who need certainty above the income their other holdings provide. They are not appropriate for everyone, but for a retiree whose Social Security and pension leave a gap in covering essential expenses, a simple fixed income annuity can be a cost-effective way to build guaranteed income floor without sacrificing the growth potential of the rest of the portfolio. Variable annuities with complex fee structures and surrender charges, which are aggressively sold to retirees, are a different product entirely and warrant extreme caution. Let me close with the 3 things I want you to remember from everything we covered today. Number 1. The retirement portfolio is not a more conservative version of your accumulation portfolio. It is a structurally different portfolio designed to deliver income now and growth over time simultaneously. Build it in 3 layers: stability, income, and growth, each serving a specific and irreplaceable function. Number 2, the biggest risks in retirement investing are not the ones most retirees worry about. The market going down is normal and expected. The real risks are being forced to sell during a downturn because your income structure is wrong, losing purchasing power over 25 years because your portfolio is too conservative, and making emotional decisions during volatility because your structure does not give you the stability to stay the course. Number 3, low-cost, broadly diversified index funds are the foundation of an excellent retirement portfolio. Not complex products, not high-yield traps, not individual stock bets. Simple, diversified, low-cost funds held in a 3-layer structure aligned with your time horizon and income needs. Here's your homework this week. Pull up your current portfolio and categorize every holding into one of 3 buckets: stability, income, or growth. Calculate the percentage in each. Then ask yourself, does this structure match the 3-layer framework? Is my stability layer large enough to cover 12 to 18 months of withdrawals? Is my growth layer large enough to fight inflation over 20 years? If the answer to either question is no, you have found your gap. Drop a comment below and tell me, what does your current portfolio look like? Are you more worried about being too aggressive or too conservative? Let's talk about it. If this video helped clarify something important for you, please give it a like and share it with someone you know who is managing a retirement portfolio right now. And subscribe to Life Advice for a new video every week.